My video presentations for today is about definition of stock cycle. A stock cycle is typical evolution of a stock's price from an earlier uptrend to price high through to a downtrend and price low. In stock market cycles are proposed patterns that components argue may exist in stock markets. Many such cycles have been proposed, such as trying stock markets, changes to political leadership, or fluctuations in commodity prices. Some stock markets patterns are universally recognized. For example, if a bakery of bread, it requires a certain amount of flour to meet its typical order amount. Tracking these cycles eventually ensures the bakers have enough for each batch of bread and that the company can respond to increases or decreases in demand efficiency.
What is accumulation? In general, accumulation is to collect or increase the amount of something. In finance, accumulation can refer more narrowly to increase in the position size of an asset that is built up over multiple transactions. Accumulation can also refer to the overall addition of positions to a portfolio. In technical analysis, accumulation points to a general increase in buying activity in an asset. In this case, the asset is said to be under accumulation or being accumulated. Deferred annuities have an accumulation phase in the first year of contract. So during the phase, savers and contributing funds, the accumulation phase is followed by the distribution phase. During in phase, retirees begin in accessing and using their funds. So here are the case of takeaways about accumulation. Accumulation occurs when the quantity of something is added or increased over time. In finance, accumulation more specifically means increasing the position size in asset, increasing the number of assets owned or position, or overall increase in buying activity is called within asset. So the accumulation phase in annuity refers to the period where premiums are being paid or money is being put in. Stocks whose prices are rising are considered to be under accumulation. So here are the accumulation distribution, or we can call it AD. Line is an indicator that shows whether a stock is being accumulated or distributed. Understanding accumulation. So accumulation is a key concept in finance and economics because it underlies the concept of growth. For companies to increase profits and increase their share prices, they must accumulate capital to expand and invest in a new project or businesses. When a trader increases size of their position over multiple transactions, they are accumulating the stock or the other asset. A trader may want to accumulate positions over time. Instead of all at once to get a better average price, have a lower market impact or attain information from multiple purchases. Traders who take large positions attempt to limit their market impact by buying as covertly as possible, because buying too much at one time could cause the price to move up, thus increasing the cost of future purchases. Each transaction also provides information to the trader. If they place an order to buy and pushes the price up easily, they know there are limited sellers. If they place a bid and it is instantly filled, they know there are sellers and they can likely buy more without pushing the price up. Accumulation also refers to investors or portfolio manager adding position to a portfolio. In this sense, an investor is accumulating investments, as an investor contributes to their retirement portfolio over time. So they may use the funds to buy additional stocks, commodities, and other assets. When the price of a stocks or other asset is rising, especially in rising volume, it is said to under accumulation. This means that traders and investors are willing to buy the asset in mass. Once the assets start to decline in value, this is called distribution. In this sense, accumulation refers to buyers that are more aggressive than sellers, which pushes the price up. So distribution refers to sellers that are more aggressive than buyers, which pushes the price down. Example of accumulation. It is possible that investors could have multiple types of accumulation going on one time. So assume an investor is interested in purchasing PayPal. It holding PayPal. So as long-term investment in their portfolio, the addition of the stocks to other they already own would represent an accumulation stocks. So they are owning more over time. Example of accumulation. It is possible that investors could have multiple types of accumulation going at one time. So assume an investor is interested in purchasing PayPal, holding in PayPal's long-term investment in their portfolio. The addition is the stock to other they already owned would represent an accumulation in the stocks. So they are owning more over time. So the investors may also decide that they want to buy the PayPal. Once they see others starting to accumulate it, this shows that the stock is in uptrend and that price is moving higher. So the investor notes that the stock has broken through resistance in the $89 region and has been ascending since. So they initiate a purchase at $91. The stock price stalls but then it continues to move up. The investors buy more than $95. That stock continues to perform well. And that decide to buy more than $101. So this type of buying which take place over multiple transactions is called accumulation. They didn't buy their own position at once. Instead, they spread it over multiple transactions, which increase to their position size in the stock over time.
Using the accumulation distribution or AD indicator is a cumulative indicator that uses volume and price to assess whether a stock is being accumulated or distributed. The AD measure seeks to identify divergences between the stock price and the volume. It provides insight into how strong a trend. If the price is rising but the indicator is falling, then it suggests that buying or accumulation volume may be not enough to support the price rise, and a price decline could be forthcoming. A stock accumulation or distribution status can be determined using an indicator or known as the accumulation distribution line. The indicator makes use of the asset price and the volume to predict direction or validate trends. Bullish and bearish trend, as well as bullish and bearish divergence, can be detected by the AD indicator. The AD line rising while volumes are strong indicates a bullish trend. A bearish trend is a confirm when the AD line falls and the volumes are high. The AD indicator can also alert traders when a reversal is imminent. A bullish AD divergence is present when the AD line declines while the price moves in a bearish direction. In contrast, a bearish AD divergence is indicated when the AD line rises while the price moves in a bullish direction. Special consideration: accumulation in annuities as it pertains to annuities accumulation has an alternate definition. An annuity is a financial product that pays a fixed stream or payments to investor. The primary use of annuity is as an incoming stream of retirees. Annuities have two main phases: the accumulation phase, during the which investor funds the annuity, and the annuitization phase after payouts begin. Life insurance can also serve as the example of accumulation. Up to a certain age, the person may contribute a monthly premium to the insurance policy. After a certain age, they start to receive money or a payout. According to the definition of accumulation, something increases and its value or quantity rise. The price size definition of each changes depending on usage and between sectors. For instance, Businesses build up capital to finance initiatives and grow their business. Annuity owners build up value in their annuities by making contribution over time, just as investors build up stocks and other assets over multiple transactions to get better prices and reduce market impact. What happens if annuitant dies during the accumulation period? If the annuitant and owner are the same person, the accumulated value is paid to the named beneficiary upon death. If the annuitant is not the owner of the annuity, the owner retains full control of the annuity or receiving its accumulated value.
I'm Angelo A. Baluyos. Today, I'm going to discuss what is markup. Markup simply refers to the difference between what an item was purchased for and what it was sold. The formula of markup equals selling price minus cost price, or M for markup equals S for selling price minus C for cost price. Like for example, if you buy a bag for 10,000 pesos and sell it for 15,000 pesos, your markup is 5,000 pesos. On the other hand, markup can also be seen as the amount you add to the cost of an item before selling. Therefore, markup difference between the selling price and cost price. Markup usually it is called profit or revenue.
The distribution phase begins as the markup phase ends and price enters another range period. The shares are being sold over a period of time, the opposite of accumulation. This time, the sellers want to maintain higher prices until the shares are sold. Whether it is distribution or accumulation is less easy to discern at this point. It is more important to be prepared for the next signal rather than trying to predict the next move. One of the most common distribution patterns is known as the head and shoulders pattern, as you can see above. Rounding or dome-shaped pattern. So these two indicates distribution preceding the markdown stage.
So I am Johnny Puertos and I'll discuss to you what markdown is. So markdown is a business math term that refers to a reduction of the original retail sale price in order to increase sales. So in other words, it is a process where the price is least permanently changed to a reduced price. Salespersons usually offer commodities at a reduced price so that they can stimulate a commodity's demand. So how does a markdown work? So when it comes to the security market, there are two types of prices. So the first is the bid prices and ask prices. Bid prices in this case refers to the prices that buyers are offering on securities, while asking prices are prices that the person selling the securities is offering. So to get a bid ask price, you need to find the difference between the highest and lowest bidding prices. Note that it is the difference between dealer's price charges to a retail customer in exchange for security and the inside market price that is referred to as a markdown. Markdown in when the difference in price is negative, so while markup is when the difference in price is positive. So why is markdown important? Markdown helps to stimulate the trading activities among customers with believing that the numerous commissions will lead to higher sales, which will, in turn, offset the loss incurred in the negative spread.